You've written some interesting stuff about volatility positioning lately. First of all, how are things positioned right now? And based on recent patterns, what would that say about volatility?
So over the last year and a half, we've seen this trend where VIX positioning had gone aggressively short, extremely short, to now really quite aggressively long here. And so if you look at VIX positioning on either the short side or the long side, it can be a helpful signal to go the other way, right? Everyone's going to go from one side of the ship to the other side of the ship. But what I've noticed is that with respect to the VIX positioning, the signals before the financial crisis, when there wasn't QE, when interest rates weren't as dominant a part of the picture, and you didn't have the sort of lower, longer rates and volatility condition that defined 2016 and 17, the positioning signals were much weaker. And I think my argument is that if we are normalizing here on the macroeconomic side, these positioning signals will also normalize and become less effective.
So big picture, the idea is that if you just go by post-Great Financial Crisis signals, then you would say, yeah, volatility is going to come down. But if we're in a sort of different monetary policy regime, if they're no longer doing expansive, sort of easy policy, then it may be myopic to just look at post-crisis signals.
Exactly. They're going to be, I think, much less effective under this current condition where central banks are retreating, rates are going higher, particularly if we go through 3%.
We have a chart that you brought us. I have it on my terminal if we can bring it up. And it looks at VIX positioning and 10-year positioning and VIX. Why don't you tell us what we're looking at here?
Yeah, so what we're looking at is VIX positioning, the Treasury positioning. That's on a reverse axis to show the correlation, and then just the 10-year yield, which is the green line there. And what's really interesting to note is that how all those lines are moving together really since the rate bottom last September. And I think there's two things to take away from this. The first of all is that at least from those trading VIX futures, they are not. I don't think they were necessarily caught off sides by this regime change. They were looking at what their friends down the hall who were trading treasuries were doing, and they were getting increasingly bearish treasuries, and as they were doing that, they were getting increasingly bullish VIX, right?
Yeah.
I think the other thing is that correlation is actually has a real sort of intuitive understanding. If you think about it, if yields are going higher, that's going to mean things like the cost of equity is going to be higher. It means less earnings visibility. It means that the spread between the dividend yield and the 10-year yield is much wider. Therefore, there's a chance for a bigger drawdown.
So there's an intuitive link between, as you say, the charts clearly show they've been moving together, but as the yields get higher, suddenly some of the bull cases on stocks become a little bit more tenuous, and that makes the case for higher volatility. Right,
exactly. And just connecting this back to the first discussion, I would say that it's a pretty aggressive assumption to think that the VIX is going to go back to those 10, 11 prints that we saw so many of last year, unless the 10-year and the rest of the Treasury market really goes back to those 2017 conditions. And I think that's, of course, a very aggressive assumption right now with 3 hikes being priced in.
An argument that you sometimes hear, too, is that QE is fundamentally a volatility suppressant and sucking all this volatility out of the market. Do you buy that? And is that another way in which the sort of wind down of these extraordinary policies sort of breathes new life into volatility?
Oh, sure. I mean, I think there's a whole bunch of other charts you could produce that would show that the advent of global QE really was a great volatility smotherer. But in conjunction with that sort of lower stable inflation condition, that lower stable rate condition, as inflation and rates are nudging into higher levels, the volatility floor has to go to a higher space.
And then just fundamentally, the fact that we perhaps see a different shift now in the Fed's main concern. So for years, the concern was deflation or disinflation, and that was the signal. Now there's this belief that the Fed is more concerned about upside risk. What does that do to sort of portfolio management and volatility? Same story?
Well, I guess part of the question is at what velocity are we going to see see a regime shift? I think we're more tiptoeing into it than jumping into it with 2 feet. And I think you mentioned the Fed, but I think the other part of this equation is what is our friends on the other side of the Atlantic doing, the ECB, and how do they normalize it? And there's an argument there that even if Powell's going to take a more nudge into a decidedly more hawkish stance here, that the overall volatility condition is linked to what's going on in Europe and Japan, and that Mario Draghi has a much more difficult task and will probably more likely to be marginally dovish than marginally hawkish, given that he's got the currency to worry about.